In the fall of 2024, Julian was sitting at his kitchen table staring at a compound interest calculator on his laptop, trying to figure out where the missing $100,000 went. 10 years earlier, when he was just 22 years old and fresh out of college landing his first entry-level job, he had heard the golden rule chanted by every financial guru on the internet: start early. Invest just $50 a month in an S&P 500 index fund, and time in the market will make you a millionaire by the time you retire. Julian had taken that advice to heart. He cut out his morning lattes, automated his transfers every single payday, and watched his portfolio grow line by line, month after month, with the religious discipline of a monk. He felt like he was beating the system. He was doing everything the internet told him to do. But when he finally ran the actual purchasing power math at age 32, factoring in real-world inflation, administrative fee drag, and the staggering stagnation of his actual earning potential, he realized the fundamental lie he had been fed. Time in the market is real, but it is entirely useless if the foundation it stands on is broken. Most people believe that starting early is the ultimate cheat code to wealth. It is the foundational assumption of modern personal finance content, printed implicitly into every retirement calculator, every viral TikTok video, and every piece of well-meaning advice handed down by older generations. And it is incomplete in ways that do not announce themselves until you are a decade deep into the strategy, wondering why your net worth can barely buy a used sedan, let alone financial freedom. The early investment myth is not a total falsehood. It is a half-truth that masks a much harsher reality. The small monthly contribution you make at age 22 does not fail because compound interest stops working. It fails because it arrives in 7 waves of hidden friction, each one reasonable in isolation, collectively devastating in combination. The first wave arrived with the reality of inflation and the erosion of baseline purchasing power. When financial influencers show you compound interest charts stretching across 40 years, they are assuming static dollars. They are pretending that a dollar earned and invested today will buy the exact same basket of goods 4 decades from now. Economic data shows that real-world inflation, specifically on structural necessities like housing, healthcare, and education, compounds at a rate that quietly eats away at the returns of small, early-stage portfolios. Julian's early contributions were growing on a percentage basis, but the cost of the future he was trying to buy was accelerating faster than his returns. A portfolio worth $50,000 at age 30 sounds impressive until you realize that the cost of living has doubled, turning your hard-earned compounding asset into a treadmill that barely keeps you in place. The second wave was the income ceiling trap. The entire premise of investing early assumes that your primary financial engine is your savings rate out of a fixed, modest starting salary. At age 22, Julian was making $42,000 a year. Saving 15% of that income meant living on a tight budget and sacrificing lifestyle experiences during his peak physical years. What the early investment narrative completely ignores is that saving 5% of a $200,000 salary later in life dwarfs saving 20% of a starvation wage in your early 20s. The leverage of human capital, your ability to increase your earning power through skill acquisition, job hopping, and career scaling, is infinitely more powerful in your 20s than the tiny returns generated by a few $100s of automated index fund purchases. Julian had optimized the wrong variable. He spent his early 20s obsessing over a $50 monthly automated transfer while ignoring the fact that his career trajectory was locked into a low-growth corporate ladder. The third wave was the opportunity cost of liquidity and risk capacity. When you lock your surplus cash into long-term investments at a young age because you are terrified of missing out on the magic of compound interest, you strip yourself of the most valuable asset a young person actually possesses: aggressive optionality. Real wealth is rarely built by slowly grinding out 7% annual returns on pocket change. It is built by having dry powder ready to capitalize on asymmetric opportunities, starting a business, buying a cash-flowing asset, or relocating to a high-opportunity market. Julian's brokerage account was growing, but his bank account was perpetually lean. When a high ROI business venture presented itself to him at age 26, he had to pass on it because every spare dollar was trapped behind retirement penalties or market volatility risks. The early investment dogma had convinced him that preserving every penny in an index fund was the only path to safety, blinding him to the reality that cash liquidity in your 20s is often worth 10 times its face value if deployed correctly. The fourth wave arrived as the psychological burnout of delayed gratification. The internet tells you that if you just suffer now, eating ramen, skipping vacations, and funneling every extra dollar into the market, future you will be a millionaire lounging on a beach. But human psychology does not operate on an Excel spreadsheet. By year 7 of his relentless saving strategy, Julian experienced a severe burnout wall. He looked at his peers who were traveling, networking, and investing in their immediate environments, while he was staring at a digital portfolio balance that couldn't even cover a down payment on a modest apartment. The psychological weight of forced hyperfrugal compounding at an income level that couldn't support it led to a period of impulsive counterspending. He wiped out months of disciplined savings in a matter of weeks on lifestyle upgrades because the psychological spring had snapped. The early investing narrative never warns you about the cost of living a half-life in your 20s just to fund a hypothetical version of yourself at age 65. The fifth wave was the hidden drag of platform fees, tax friction, and asset allocation inefficiency on micro-portfolios. When you invest small amounts early on, you are disproportionately penalized by transaction realities. Fixed management fees, suboptimal fund choices, and the lack of tax loss harvesting sophistication on small balances eat into returns before they even have a chance to compound. Furthermore, young investors are often herded into generic, one-size-fits-all portfolios that fail to account for the unique economic cycles of their generation. Julian's early accounts were leaking capital through subtle structural inefficiencies that the compound interest calculators conveniently left out of the fine print. The psychology of what happened to Julian is not a character flaw. It is the predictable output of a financial culture that prefers passive automated consumers over active strategic wealth builders. When Julian started investing at 22, he was not simply participating in a market mechanism. He was purchasing an identity, the identity of the smart, disciplined long-term investor praised by online creators. The phrase compound interest is used in the personal finance lexicon for exactly this reason. It fuses a mathematical truth to an emotional security blanket so completely that the investor stops analyzing their overall financial ecosystem and starts blindly trusting a formula. Julian did not stop being intelligent when he set up his automated transfers. He stopped looking at the macro picture and became a person defending a narrative he had bought into before he even understood how the global economy actually worked. The sixth wave is the one that reveals itself only when you try to calculate what those early years actually cost you in terms of skill development and network building. Money invested in yourself, learning high-income skills, attending industry conferences, building a personal brand, or launching a side venture, carries a rate of return that makes the stock market look like a savings account. $1,000 spent on a high-level skill in your 20s can easily multiply your annual income by $20,000 within a few years. That same $1,000 sitting in an S&P 500 fund might turn into $2,000 after 10 years of compounding. Yet the early investment gospel tells you to hoard that $1,000 in the market rather than betting it on your own earning capacity. It is a philosophy designed for people who have capital to spare, applied cruelly to people who only have time and potential to spend. The seventh wave is the one that follows you regardless of market performance, because it does not live in your brokerage account. It lives in the account you never opened, the account of maximized human potential. Using a standard market return of 10%, saving $200 a month from age 22 to 62 will mathematically yield a tidy sum at retirement. But if that same person had spent their 20s aggressively scaling their income, building businesses, and developing assets that generate cash flow, their earning capacity at age 35 could allow them to invest 10 times that monthly amount effortlessly. That is the real cost of the early investment myth, not the money you spent, but the financial scale you never achieved because you were too busy patting yourself on the back for saving pocket change while your income stayed flat. By the time Julian sat at his laptop running the numbers, his complete financial reality looked like this. Total portfolio balance after 10 years of disciplined sacrifice, $64,000. Total inflation-adjusted purchasing power, $48,000. Total career income growth over the same decade, a meager 12% bump. The strategy that was supposed to make him a millionaire had instead trapped him in a middle-class holding pattern, trading his vibrant youth for a portfolio that couldn't survive a single major macroeconomic shock without fracturing. My name is Bobby, and I have spent years doing the math that the people selling you generic financial advice are hoping you will never finish. This channel exists for the Julian who is staring at a compound interest calculator at midnight, certain he did everything right, unable to understand why the numbers refused to set him free. If you found this video and you recognize that feeling, subscribe because this is what we do here every week. The smarter path does not require abandoning the stock market. It requires treating wealth creation the way you would treat any serious enterprise, with a complete accounting of leverage, not just automated obedience. The criteria are specific: Total capital allocation to long-term passive investments should be scaled dynamically to income growth, prioritizing aggressive skill acquisition and cash-flowing asset creation during the first decade of your earning life. The primary financial focus between ages 20 and 30 should not be saving a fraction of a small salary, but multiplying the size of the shovel you use to dig your financial foundation. The path to wealth is evaluated not against the comfort of a slow compound interest chart, but against a complete 5, 10, and 20-year income model that includes the opportunity cost of premature frugality and the exponential power of high-level earning capacity. Financial strategy that passes all three tests is not a shortcut. It is a master plan, and master plans are allowed to be ambitious. If this video made you want to reevaluate the strategy you've been blindly following since your first paycheck, the free guide in the description was built for exactly that moment. The income scaling framework translates the 7 traps Julian discovered the hard way into a single actionable blueprint you can deploy right now. And if you want to understand how I think about the relationship between the capital we save, the skills we build, and the financial freedom that actually follows, Bobby's journal is where I work through it all in depth. Julian still invests, but the rules of his game have entirely changed. The illusion is expensive to maintain, and not just financially. The most dangerous number in personal finance is not your savings rate, your expense ratio, or your age when you start. It is the cost of the story you told yourself about what building wealth was supposed to require. I'll see you in the next one.